In this video, we are presenting a method on how to exploit the power of stochastic indicator, using multi-time frame approach. Analysis of stochastic indicator using multi-time frame approach is able to produce a sharp signal, as well as able to avoid the trap of fake signal. A stochastic oscillator is a momentum indicator, comparing a particular closing price of a security to a range of its prices over a certain period of time. It is used to generate overbought and oversold trading signals, utilizing a 0 to 100 bounded range of values. The formula used for stochastic oscillator is as follows: %K is defined as the current value of stochastic indicator. C is the last closing price. L14 is defined as the lowest price of the last 14 periods. H14 is the highest price of the last 14 period. %K is C minus L14 over H14 minus L14 times 100. The resulting value of %K is the current value of stochastic indicator. The plot of the stochastic oscillator is shown in this figure. From this figure, the area between 0 to 20 is oversold zone. The area between 80 to 100 is overbought zone. Between 20 to 80 is a trending zone. We also have two lines in stochastic indicator, namely baseline with green color, and signal line with red color. Some common mistakes of new trader, in using stochastic indicator are, they generate sell signal, if both stochastic lines cross below overbought zone, and headed down. And then, baseline is below signal line. New traders also often generate buy signal, if both stochastic lines cross above oversold zone, and headed up. And then, baseline lies above signal line. Two possibilities that may occurs, by generating buy, sell signals, using single time frame stochastic. The first is obtain an accurate signal, the second is obtain a fake signal. To avoid being trapped by fake signal, multi-time frame approach in using stochastics indicator is needed. In multi-time frame stochastic approach, there are two time frames that need to be considered. They are: the first is current time frame or CTF. It is defined as time frame where the trading will take place. The second is higher time frame or HTF. The rules for CTF and HTF time frame selection are as follows. If CTF is M5, meaning that we will trade in 5 minutes time frame, the most suitable HTF to be selected is H1. If CTF is M15, meaning that we will trade in 15 minutes time frame, the most suitable HTF is H4, and then, if CTF is H1, HTF is D1. We have two steps, for rules of buy signal in multi-time frame stochastic approach. The first is we have to take a look to higher time frame or HTF, and the following conditions should be met. Both stochastic lines are headed up, stochastic lines are above oversold region, baseline is above signal line. And then, we go to the current time frame or CTF. Both stochastic lines are headed up, stochastic lines are above oversold region, baseline crosses above signal line. If all the conditions in HTF and CTF are met, then buy signal is valid. We also have two steps, for rules of sell signal in multi-time frame stochastic approach. The first is we have to take a look to higher time frame or HTF, and the following conditions should be met. Both stochastic lines are headed down, stochastic lines are below overbought region, baseline is below signal line. And then, we go to the current time frame or CTF. Both stochastic lines are headed down, stochastic lines are below overbought region, baseline crosses below signal line. If all the conditions in HTF and CTF are met, then sell signal is valid. As a conclusion, By using multi-timeframes analysis of stochastic indicator, we can generate a sharper signal for entry, and it can also avoid being trapped by fake signal.